IRS audit techniques for restaurants and bars. Regardless of the type of restaurant or bar, one consistent fact regarding IRS audits is that they all have numerous quick sales transactions with smaller dollar amounts. Many, significantly smaller or closely held, are cash-intensive, and employees or owners handle large volumes of cash transactions daily. When a sole proprietor counts cash, tallies receipts, records all entries in the sales journal, and makes bank deposits, there's a possibility that not all money is reported and deposited. While this can also be true when the same person takes the order, fills the order, receives the payment, records the amount, and may even balance the cash register at the end of the day. As such, there is a potential risk of employee theft and embezzlement unless the restaurant implements internal quality controls. Conversely, some operations have a sound system of internal controls and owners who correctly report all transactions. These are successful and profitable businesses, partly because once a system's design truthfully accounts for every transaction, owners have all the verified information from the accounting system and make accurate defensible management decisions. The challenge for the IRS is to separate owners who comply with the tax laws from owners who are not. To do this, the IRS examiner focuses on the following: internal controls, unreported income by the restaurant, cost of sales, unreported tip income by the employees. The IRS examiner will ask a taxpayer to explain the entire customer process, from the food order to paying the check, how it gets recorded in the books, by whom, and where. The examiner outlines the process and test amounts by doing the following. Examine the customer checks for a sample shift, for example, the 6 a.m. shift at a diner. They'll ask, is the amount consistent with the taxpayer's initial interview statements? When reviewing the cost of goods and services, the examiner will look to see if items replenish within a day or two. Trace this amount to the monthly records and verify it with the amount reported in the statement of profits and losses. Note the ratio of customers' cash, check, debit card, and credit card payments. And address whether this is consistent with initial interview statements and observations appropriate for the business. Determine how cash is stored, used, and deposited. If the money received differs from the amount deposited for your sample day, you need to explain how. Apply the taxpayer's stated markup to purchases reported in the books to determine if it is consistent with written gross receipts. Cash management practices are a good indicator of the reliability of internal controls. If the restaurant or bar has no point-of-sale system requiring all transactions to be hand-tallied, the IRS examiner will ask how proper reporting and measures are in place to discourage theft. Internal controls can also lack an implemented system with rules designed for the point-of-sale system, such as recording cash tips. A bartender may handle all cash transactions in a small bar, including daily balancing cash drawers. This lack of separation of duties for a system of controls necessitates extending the income probe well beyond the minimum required by Internal Revenue Manual guidelines.